the Nifty Bank is starting up as well, about 1/3% higher. So Nifty Bank, at least, is the word go, doing better than what the Nifty is doing. 1,200 stocks are higher and about 780 stocks are lower at this point. Mid-cap index is up 1/3%. The Nifty heat map comes up on your screen, and we'll do a quick check in terms of where stocks are opening before we go any further. So just, where stuff is landing this morning. Bajaj Auto, Apollo Hospital. So it's, largely higher at this point. Tata Motors Passenger Vehicle and Eternal and HDFC Life on the other end. So that's the open. It's neither here nor there. It's about 10 points, 12 points. I'm sure specific stocks in the broader market more interesting open. Surabhi.
Yeah, absolutely. And there's so many names out there like V2 Retail, IRB. A lot of positive result reactions, by the way, this morning. And we'll talk more about them as we go forward. But on the Nifty, things are very, very quiet. Just 6-7 points up. So the Nifty is not able to start with a bang. Let's see what's happening at individual stock level. Bajaj Auto, Kotak Mahindra Bank. Of course, you just heard lots of the commentary there from Mr. Uday Kotak and Mr. Vaswani. That stock's up almost 1%. Bajaj Auto, Tata Consumer, these are some of the other names. There's Titan as well on the upside. There's some buying on ITC, but then it just completely fizzles out. The banks have a bit of a positive bias, but no major moves. So SBI, ICICI Bank, they're all up 0.2, 0.3%. Kotak actually is the best of the lot, at least at this point in time. On the downside, Tata Motors, PV, those numbers are looking so disappointing. And it's not just about this quarter. The company's cut its outlook on the EBITDA front as well going forward. They've called out challenges in big markets for JLR like China and the US. And the street just was not prepared for this. 6% down on Tata Motors PV. Okay, beyond that, there is no major headline grabber on the index. Other stocks that are down include an Eternal, Max Healthcare, Interglobe Aviation. That's it. Some total change of just 5 to 6 points on the Nifty. Nigel.
Well, that's right. A few stocks, though, that are bouncing around in trade. You have transformers and rectifiers. The stock had seen a sharp correction after being barred by the World Bank. There was relief that came in from the World Bank on Friday. The stock recall was up 10%. Today, it's seeing some follow-through buying. So that's up close to around 5% as we speak. Good up move is what you're seeing. Glenmark, well, the stock actually has gotten away with a cut of only around 2%. The street is bought into that guidance that the management has given. Now it's down close to around 3% actually. So it's trended a little bit lower. It's around that 20 DMA, which is an important mark. But the numbers were disappointing. The commentary seems to have some promise. We'll try to get you more on that particular one. SP Apparel, that's another stock from the broader markets, is bursting away. Volume's fairly decent as well. I guess they would have come out with numbers. So that one is up close to around 7%. Narayana, that's another stock that's opened up. Gap up, solid gains out there. Big volumes as well out there. 5.5% higher on that name. And Idea Forge, I think I just spoke about it. That stock, in fact, has opened up with a good amount of gains. That order win is boosted sentiment out there. So that explains why that stock, in fact, is flying away in today's trading session. And Gabriel India, from the broader markets, that's one of the losers. It's down close to around 5%. Not a stock we talk about very often. But that's coming for some profit taking, as is the case with Ashoka Bilcon. Both of them lower in trade.
Okay, I think so. It's a pretty good start. 2:1 is the advance to decline ratio. And the number one volume-led gainer on the NSE is Grow, which is up another 5%. So yeah, it's a profitable business, a very profitable business, a market leader. And from the opening, it listed, 4 days old, right? I mean, it opened at 112, and it's at 155 at this point. So there you go.
And the market cap, because I keep tracking if it's how closer is it to the 1 lakh crore? Not yet. We're talking 95,369 crores to be precise. That's this morning.
Yeah. So there it goes. So Glenmark is down 4 now, 1821. It's got large volumes on it right now. So call, I think, is still going on. Until about 9 o'clock, there was still the opening presentations, and I guess they would have opened it up to questions from analysts, etc. Garden Reach is up 2%. Pine Labs is up another 3%. Pine Labs, of course, I think just 2 days, a day old, listed at about 242. And the stock's at about 258, 260 now. Idea is starting about 1% higher. It's holding but large volumes. Transformers, I think Nigel mentioned, 6%. So it crashed, and Friday was a big recovery day, and today it's continuing some of that move. Narayana, 6%. That's it. That's largely the bulk of what we're seeing across the board with what's coming up. Idea Forge, I think we mentioned, Ahluwalia Contractors, and Universal Cables is up 5.5%. Uniparts is up 10%. So, some of these smaller names are shooting up as we speak. So we'll come back to some of this. Silver bees against spot. Some of them are down about 3-4%. So precious metals on Friday, if you look at gold, silver, etc., saw a little bit of liquidation. I mean, all the listed ETFs are down between 3 and 4% this morning, and they're coming up with volumes as well. Well, let's welcome in our next voice on the show. Amish Shah is head of India Research, Bank of America Global Research. He's in our studios to take the conversation forward. Amish, welcome back. Thank you very much for joining us here.
Pleasure.
So it's been a while. It's almost 6 months, right, since we've last
at your studios. We interacted over
August.
virtually, yes.
Yeah. How's the view changed? How's it kind of evolved now? Where do we stand? I mean, we're also ending this year, looking into the new one. What's the view overall?
So Prashant, I think the good news is that a large part of the earnings downgrades are now behind us. So if you look at the numbers year to date, FY26 earnings have been cut by 10 percentage points. FY27 is cut by 7 percentage points. And as a result, consensus is now expecting only 8% earnings growth for Nifty for F26 and then 15%, very close to our numbers. We had a big gap earlier. That gap has meaningfully shrunk. As a matter of fact, despite the fact that second quarter earnings were positive, consensus has still cut estimates this quarter, right? And so as a result, I think the earnings cuts are now behind, which is always a good news for the market. The other thing is that the trajectory of earnings growth is now going to improve. So you had FY25 at 5.5%. The first half has been 8.6. We think second half is going to be close to 9. And then FY27 we think will be 13. So the growth trajectory is...
This is all Nifty 50?
This is all Nifty 50. So the growth trajectory is actually improving. Valuation on the other side, I would argue, has still not corrected, because while it might seem that the markets have gone nowhere or slightly over the last 1 year, markets are slightly down. The problem is that, the valuations obviously in September when the markets peaked last year were high to begin with. Since then, markets have gone up by 9.6% year to date. Earnings have gone up by 9, as I was mentioning. So earnings have actually just kept pace with the market performance. Valuations have just been where they were when the markets were seeming expensive last year. So I think incrementally, the way I think about it, difficult to justify a valuation expansion, but market performance will be driven by earnings growth, which, as I was arguing, is going to be on an upward trajectory now.
So that's the tricky part, Amish, isn't it? Because it's been such a polarized year. And you're right, at the index level, you'll say, okay, market has been flat. Even on the Nifty 50, you have stocks which have rallied, 40-50%. Something like a Maruti or, Bajaj Finance, etc. And you have stocks that have fallen 40-50%. Tata Motors and, a couple of others. So it's been very polarized. Now, when we try and apply this valuation and earnings turnaround argument and try and find areas where there is growth, which is at, if not a reasonable, but at least not an exorbitant price, do you see such pockets somewhere at the end of this year? So
we do. And I think that dichotomy is still likely to continue. So let's say when you talk about mass consumption categories like staples, footwear, apparels, etc., we think the growth is going to be a shallow recovery. Similarly, when we talk about capex, we think that the growth is going to be quite shallow recovery. So there will be disappointments. But the moment you turn to rate sensitives, because we do think that RBI will keep cutting rates, so rate sensitives like real estate, REITs, the regulated power utilities, financials, those will do well. Within consumer, we think consumer discretionary will do well. And a wide variety of consumer discretionary will do well. So I think there will be categories like rate sensitives and discretionary that does well. On the other hand, you will have pockets of capex and mass consumption that will be laggards.
But to complete the argument, has that already been captured in the price? Like I said, rate sensitive, you're saying. I'm just taking an example, Bajaj Finance, it's rallied 50% this year. So if you look at the rate sensitive universe, where you see growth, do the valuations support a fresh buy?
Yes. So I think by and large, financials as a pack, still is not expensive. For the last couple of years, I'm sure that every guest who must be on your show must be arguing that financials is the only sector that screens out cheaper.
Yeah.
It does.
Yeah.
And as a matter of fact, after 2 consecutive years of earnings downgrade, now it looks like there's an earnings grade cycle coming in for financials. Over and above that, the regulations for financial sector is now improving. We've seen that in the last RBI policy meeting, plus beyond that, now we are seeing the foreigners buying stake into mid-sized banks, etc. So all these regulations are also now quite supportive for the growth within the financial space. So by and large, I would argue that despite the rally, financials as a pack overall, whether you look at NBFCs or banks or SOE banks or mid-sized banks, everything still looks quite attractive to us.
All right. Hi, Amish, and good to have you in the studio as always. Tell us about the recent elections. The NDA coming out trumps in Bihar. The market would be thumping the table and saying this is what we wanted. However, if you look at it closely, the kind of cash that's being doled out, now that'll put pressure on, say, a state like Bihar, that as it is, the deficit number is very, very high. And now you will have this cash that will be doled out, which will be higher than the capex. It could be restricted to, the state, which is the hope. But, you'll have more number of elections, and it could be a contagion effect. How worried are you about this? Because all this money that's being doled out will have to be recovered from somewhere else. Case in point being West Bengal. Yeah, alcohol tax is going to go up from December 1st. How worried are you about these freebies suddenly coming to the system, capex on a bit of a back burner?
So, Nigel, very rightly, as you put it, so there is always going to be a trade-off because the resources are limited.
Yeah.
And on one hand, you want to stimulate consumption. The other hand, you don't want to let go capex.
Right.
But to your point, if you give money to one, money has to be taken out from somewhere else.
Yes.
So I think there will be a trade-off between capex and consumption. In the bargain, right now, it looks like that consumption will win, capex will lose out. So to add some numbers to the question that you asked,
yeah.
In FY24, which is 2 years back, we had a center plus state governments put together give out a total of $90 billion in subsidies.
Okay.
Right? Over a 2-year period, not just through subsidies, but through subsidies plus tax cuts plus RBI rate cuts, we've added $60 billion more to the consumption stimulus. So 90 has already become 150.
Yes.
And then if I fast forward one more year, with the pay commission hike and further RBI rate cuts, we think that will be another $40-50 billion that will get added to the consumption stimulus. So 90 over a 3-year period will become 200, right? And obviously, to your point, therefore, that if consumption stimulus is going from 90 to 200, that has to be taken away from somewhere, which unfortunately is capex. So that is part of our reason why I was arguing that capex growth will come off. Secondly, if you think about it, we all know that large part of the capex growth in India is driven by government.
Yes.
And over the last 5 consecutive years, government has been on the path of fiscal consolidation. But with the pay commission hike, possibly with the finance commission report that is due by the end of this month, there's a possibility that even if the government does not consolidate fiscal next year, there is just no more money left to accelerate capex meaningfully. Right. So we'll be lucky if we have 10-11% kind of growth continue for capex. If the government wants to consolidate further, then even 10-11% for capex will be a challenge.
Got it. And just to revise on the Nifty, I think the last time we spoke, the target was 25,000 odd. It continues to remain around 25,000?
Absolutely. So for this calendar, our target was 25. It still is.
I'm pretty good.
And we were arguing that, if there are 2 or 3 factors that play out in India's favor, which is a trade deal conclusion, which is not concluded, but, there is more clarity on it now because India has cut down on Russian crude. So at least that 50 should come down to 25. If there is more visibility of RBI rate cuts, which I think also has improved, then we were arguing that 25 can go to 26. So I think between 25 to 26, till the time these positive factors stay, is the target for this calendar. And thereafter, as I was arguing, that valuation multiples stay the same.
Yeah.
Market compounds in line with earnings growth.
Just one more word. We discussed a few sectors, but tech we didn't discuss. And the last time around, we were chatting about how it's under-owned and,
yes.
Interest is very lower as well.
Yes.
How are your positions right now out there? Because that's been the big under-owned sector. It's underperformed as well, with good reason,
yes.
with the kind of growth rates that you're seeing. But now there is optimism. There is some kind of attention being put to AI. Hopefully, growth picks up as well. And hopefully, some of those headwinds are behind. How are you approaching that sector?
So, Nigel, IT, we are looking at very bottom-up because, let me put it this way, that earnings downgrades even for IT is now over. But if you look at the large-cap IT companies, they are all expecting revenue growth of mid-single digits. Which A is not exciting, and B, there is no visibility on whether these numbers will get upgraded further. Yeah. And in the context of 5-6% kind of revenue growth, valuations, especially with the risk of AI as a debate still out there, is not necessarily cheap.
Yeah.
But then there will be some companies that we like on a bottom-up basis. So IT is more nuanced bottom-up. By and large, as a sector, if I have to say, I would say we are more neutral weightish.
By the way, with that, there was India, US, there was a flash oil minister saying that Indian oil PSUs have signed a deal to buy some 2.2 million metric tons of LPG from the US. So that just came through. I'm not sure what would the value, I mean, it should be large.
Absolutely. And you know, these are all signs about how India can potentially go from 50 down to 25% tariffs for sure.
Yeah.
And possibly try to argue for even lower.
That
This
penal
is,
tariffs should, I mean, I think.
It's just to add to your point, Prashant, the ministers also clarified it's going to be 10% of our total requirement. So it seems fairly sizable.
Yeah.
Maybe a step forward and finally, you know, a
So I think
breakthrough on
we
the
import
deal.
about 65% of LPG, and I think a requirement, and so seems to be a shift away. That's the flash that I'm talking about. All, as Amish said, signs that maybe a little bit of give and take, right? And this is the give in that sense, and we'll see what we get. Those, I mean, the assumption is that 25% tariffs should disappear. Should go away, and then of course, I mean, the rest of the 25% perhaps will be worked lower as well. In your report, in your published report, Amish, I mean, what I'm hearing from you is that don't expect anything super normal from here, right? I mean, more normal kind of markets, constructive, and you talked about financials, etc., as you know, a place where one will tend to make money. But any outliers from other sectors, anything you can kind of sort of, you know.
So, you know, within consumption, as I was saying, that, you know, there is going to be a split between stocks that do well and the ones that don't. You know, so we think that as far as the mass consumption category goes, most of the lower income, middle income households are still in the mode of deleveraging, because remember, since COVID, for 5 consecutive years, they have kept on levering up. And that was reflecting in the unsecured retail growth over the years. So they are now in the phase of deleveraging. So the money that we were discussing, the money that the government is putting in your pocket through tax cuts or rate cuts, etc., that goes to delever more rather than go and consume. But as far as the premium consumption categories go, there, you know, if you're a well-off Indian, whether you invested in equities or gold or property, you've made money, and therefore they were consuming, they will continue to consume. So therefore, we think within consumption categories like you know, travel and tourism, alcoholic beverages, jewelry, you know, four-wheelers. So the more alcoholic beverage, you know, so the more discretionary categories or premium consumption categories does well. At the same breath, things like staples, footwear, apparels, you know, so those are more mass consumption categories. There you will see growth, but it will be a very shallow recovery, because a large part of the money available in your pocket is going to delever rather than consume.
Amish, we'll leave it there. Good conversation as always. Thanks very much for dropping by to our studios. Appreciate it.
Thank you very much.
Thank you.
All right. That's view from Bank of America Securities. Well, with that, just a quick glance back on the screen. Markets actually picked up some pace now, 64 points higher. So it's looking a little better for the Nifty. And what is actually taking it higher? A couple of financial names. Kotak is now up over 1%, 1.2% almost. Axis Bank and SBI Life. So financials have basically started moving. And that's what has gotten us here. Bajaj Auto, by the way, is the leader on the Nifty right now. Stock's doing really well, 1.5% up on Bajaj Auto. Let's, however, move on and get to some more corporate conversations now. IRB Infra saw pretty good growth in tolling revenues. It was about 11% growth in their tolling revenue in the second quarter. Private InvIT won a record 9,200 crore rupee order from the NHAI as well. The company, by the way, changed its accounting policy in the quarter gone by. So we need to also understand really where the performance and the numbers are now. Anil Yadav, CEO of Business Development, is with us. Anil, thanks so much for joining in. So I'll get to that new order and that tolling revenue growth. But can you just run the numbers? Because you had this accounting change. The numbers that we have, your revenue is up about 10.5%. EBITDA margin, EBITDA is up 8%, and the margin is at about 52-53%. How would you, describe the trends in the quarter gone by? Because you seem to have done a lot better than a lot of the other EPC players in this period, which is obviously spoiled by monsoons.
Yeah, so I think if you look at, we operate in two segments predominantly. One is the toll business and other is the EPC. Though there was some, because of the monsoon, there was lower EPC execution, but our toll business has seen a very healthy growth. And if you look at in terms of the toll, the EBITDA margin is 85 to 88%. So automatically, the moment composition of the toll increases, automatically your EBITDA margin further improves.
Okay, so let's talk about this toll revenue growth of 11%. I mean, what are the trends? And typically, I think the third quarter anyway is even stronger. So what visibility do you have on the second half now? And anyway, cars have gotten cheaper, right? So maybe more cars on the road and therefore more toll revenue in a simplistic way.
I think the car typically only accounts for 15 to 20% depending upon which highway you are talking about. It's largely the commercial traffic, which 85% is the commercial traffic. And definitely the growth in the car post-COVID, we have seen around 10 to 12% growth in the car traffic. And that has led overall traffic also in range of 6 to 7%, some are at 5 to 6%. So considering that now it was extended monsoon and the monsoon this year was severe, we expect that now considering the monsoon is over, we expect better toll revenue growth in the coming quarters.
Okay, all right. Hi, Mr. Yadav. Good morning and good to see you. Just to reconfirm the guidance that you had given us earlier, on toll, I think you were working with double-digit revenue growth, and on construction, around 4,000 crores. You could correct me on those numbers. And what is the guidance for this year?
Yeah, so I think the guidance which we have given, we are on that the toll revenue will grow in double digit. And in terms of the construction, we will be reaching close to 4,000 crores kind of mark for this financial year.
All right. You know, some peers have been complaining about execution hassles, about delays in payments. Have you experienced anything on that front?
So I think there the difference between us and the EPC companies that our 85-90% business comes from the asset business. We have 80,000 crores kind of asset base, and since we have bagged one project, we will be reaching closer to 90,000 crores kind of asset base. So our large portion come from the EPC, and in terms of we don't do any third-party EPC. Predominantly, we do a EPC for the private InvIT, which is owned by 51% by IRB, 25% by GIC, and 24% by the Ferrovial Group. And in terms of toll business, that is the cash collection. There is no deferral of the income. It's basically the moment the vehicle crosses the toll plaza, they pay us. And on construction side also, we don't have any kind of delay in terms of receiving the revenue.
Can you tell us more about the private InvIT and what you're thinking there? What kind of assets are you looking to add? The recent order win, I think it's 9,200 crores, right? So how many more assets are you going to add? What is the plan for monetization? What should we expect on the private InvIT?
Yeah. So I think private InvIT has recently sold, where we own 51%, recently sold 3 of the asset, and in terms of EV was roughly 8,400. They have got an equity of around 5,000 crores. And now they have bagged this 9,270 crores kind of upfront payment asset. And this is the part of Lucknow and Ayodhya and the Gorakhpur, and other part is part of Lucknow to Varanasi. So these are the religious places, and we have seen that the state GDP is doing good. So I think on backdrop of this, this is the good win as far as private InvIT is concerned, and this is expected to, in terms of asset size, expected to increase the asset side by 10%, and similar line in terms of the revenue as well. When we are talking about kind of 10-11% kind of toll revenue growth, with this asset addition, the toll revenue growth will be again further increased by 10%. So we are talking about 18-20% kind of toll revenue growth once this asset starts.
And when will that be?
So I think we have just received the LOA, and we will be planning to make the payment in this financial year. And towards the end of this financial year, that execution of that the project tolling will start, because it's a TOT. So they are tolling post the payment to the authority, the tolling will start.
So you're saying that with the addition of this asset, next year onwards, your toll revenues could go from what is right now about 11%. It could go up to 18%.
18 to 20%.
18 to 20%. Okay.
All right. Mr. Yadav, you could tell us how is the BOT bidding pipeline, with GIC, Sintra as partners. Will the hit rate of tender wins go up? If you could give us a sense out there, how is the first half of the year transpired, in terms of BOT, TOT awarding? And how is the second half of the year expected to shape up?
Yeah, so I think in terms of, if you look at our market share in terms of TOT, we have 42% kind of market share. If I will talk about just immediate next 1.5 months till December end kind of bidding pipeline, there is almost 25 to 30,000 crores worth of TOT which is up for bidding, and around again 28 to 30,000 crores kind of BOT which is up for the bidding. And we will be participating in these projects. So I think the pipeline looks robust. First half, the award was a bit lower, but now it has started. And I think we believe that, as we have seen in the past as well, typically the award picks up in the second half of the financial year.
Okay. Also, what about the Ganga Expressway? I think the commissioning is expected in the second half.
Yes, the Ganga Expressway is expected to commission by end of this quarter. So I think that will be the one asset where the tolling will be starting.
And how much will that add? Because you said, with this 9,200 crore asset, you said next year, by the time it's operational, your toll revenue will be, showing 18% growth. As Ganga Expressway gets added up, and what is the expectation?
I think Ganga asset to begin with, it will be not that significant to begin with. It will gradually ramp up. I think since we are too close to the start of the project, once project start, we can share the revenue numbers.
Okay. So just to kind of go back and confirm, what is the yield you're expecting from this asset, the Ayodhya asset, 9,200 crores? And with what kind of margin and what kind of yield does it come with?
I think typically our bidding parameter is around 15.5% kind of equity IRR on which we bid. So that same project is also bidded on that parameter. And with the debt equity of 65-35 is the typical debt equity ratio on which one bids.
Mr. Yadav, just to confirm, around 15% ROI.
15%, yes, a return of 15.5% return on equity.
Okay. All right, Mr. Yadav, we'll leave it on that note. Thank you very much for joining in. That's IRB Infra compared to a lot of the EPC players, which have had a complete washout quarter thanks to the monsoons. They've done fairly okay. Stocks also up about 4%. Tolling revenues have been looking strong. We'll take a break on that note, come back on the other side, and we'll have more coming up in just a bit.
Right. Okay.
Welcome back. Markets doing quite well. We're up close to around 60 points. And the Nifty Bank, the one that we've been spotting, that's the one that's been leading the charge. And in today's trading session, it's doing an outperformance. But the Nifty Bank can only do so much. If the markets need to move up, you need some support coming in from the tech space. So let's discuss that. We're now joined by Sumit Jain, Senior Research Analyst, CLSA, from the CLSA India Forum 2025. Hi, Sumit. Good morning. Good to see you win. Well, we had a brief take from Vikas the last week about IT, and you all have a contra call out there. And, that would be your big call. So tell us the top factors that are making you positive on tech, while, most on the street are a little bit cautious on the sector with regard to growth, with regard to challenges, as well as the global headwinds. Please go ahead.
No, yeah, surely. Good morning, firstly, and thanks for having me on your show. So we have actually been quite positive on the sector almost for last 6 to 9 months, primarily because of the medium to long-term opportunity around Gen AI. I think there has been a lot of talk on the street that there will be a lot of deflation impact because of Gen AI on the existing revenues. But on the contrary, we believe that the technology stack is so complex to build Gen AI applications that you need IT service companies to integrate those solutions. And that's where, we did a lot of in-depth research last year, and we came out with this Gen AI report early in the year in March, and then followed it up with the Gen AI Access Days, where we hosted experts from NVIDIA, Salesforce, people from across technology stack, and they all have to say that they cannot implement their solutions without the role of system integrators. And that's where, I think this year the sector got impacted because of tariffs. But I believe the general narrative on the street that Gen AI is going to have a negative impact on IT services, we don't buy that argument. And in that context, if you look from a macro cycle, we believe that next year is going to be a stronger growth year for Indian IT, in the sense that it's a midterm election year for US next year. If you look at S&P 500 earning growth, as per Bloomberg consensus, it is at 13% right now for the next year, which is higher than last 10-year average of 9%. And as you know, 60 to 80% of revenues for Indian IT come from US geography. That clearly has a positive tailwind for the entire sector. So structurally positive as far as Gen AI is concerned. And mind you, the way cloud technology has evolved over the last 2 decades, AI is ahead of us over the next 2 to 3 decades. So it's not just a 1 to 2 year cycle, but a multi-year cycle where system integrators will have a big role to play. So
Sumit,
positive both from cyclical and structural perspective.
Sumit, hi. Great to have you with us. And this comment that Vikash made last week when he was with us in the studios, it really stuck with me, because I think you all are the very few names on the street who are actually calling for a positive view on IT and saying that, and I remember what Vikash said. He said that Indian IT typically has been not too great at inventing a new technology, but we've been among the best adopters. I mean, using that technology and really, going up the growth curve. So just expand on that. How do you see this playing out? Because a couple of things are stacked up. One, the disinflationary impact. You just don't need so many people to do more mundane tasks within IT as well. And we've seen maybe some sign of that, maybe not fully. For instance, the TCS layoffs, though they're not equated to AI per se. So just explain the disinflationary part and why you think that's not going to be a problem. And also more structurally, in a world where investors are looking for the technology inventors and creators, I mean, the NVIDIAs of the world, I mean, does Indian IT really stack up? Is it really going to get investors' attention?
No, yeah, I think, the key point, if you look at how Indian IT has reinvented itself over the last 3-4 decades, is by reskilling of their employees around every major technology cycle and making sure that they are involved with their clients to understand their enterprise workflows. And I guess this is where, even if you look at the current Gen AI cycle, the enterprise workflows, the domain expertise is what is required to implement these Gen AI applications. And mind you, Gen AI is just 4-5% of the overall revenues of these companies. So I think the way why we are positive that they will be able to adapt is the reskilling of employees is happening at a rapid scale. Now in the Gen AI world, you need to deliver your solutions along with agentic AI and AI agents. We visited HCL's AI lab just a couple of weeks back, and they showed us how they are integrating their AI agents along with the market available agents like Microsoft Copilot or Google Gemini. So the point is revenue per employee will pick up for all these companies. It will not be a headcount driven model anymore. And that's where I think all the companies, if you look at the last 3 years, the revenue per employee metric has been moving up. And probably we see that metric to further move up. And that I think will be a key thing for us to watch, that yes, these companies are reinventing themselves. So maybe I don't know what it implies for the job growth in India. But as far as these companies' revenue growth or profitability is concerned, we are very confident that they will be able to revive themselves. And the recent quarter results was a reflection of that.
And it's great you're sharing that, because we, as people in the media and of course the analyst community, perhaps we'll have an absolutely new way of reading IT company results. And maybe that metric that you mentioned, revenue per employee, that's going to become a big part of how you measure and gauge productivity. Just in terms of revenue growth, by which quarter will it start showing up in the actual revenue growth number? Is it going to be Q2 FY27, Q3? I mean, what are we talking?
See, I think, first of all, we need to understand that this is a mature sector. These companies, in terms of market share penetration for Indian IT, it's already at mid-teens. So we are talking about a growth for these companies probably in mid to high single digits, not in double digits anymore. But these companies are very strong free cash flow generating companies with a very good dividend payout. And that's where, I think the growth for the sector, we believe, will be somewhere in between 5 to 7% in FY27, which will be better than what we have seen in FY26 because of tariff-related concerns. And I think to another point, why we believe that Gen AI is not having a huge deflationary impact is also because BFSI, which is actually seeing tailwinds in US, grew at high single digits to low double digits this year. Even the order booking momentum has been pretty strong. So to your question, I think we have already seen some recovery signs in the recently concluded quarter. And I believe that with a strong order booking momentum, the YOY growth numbers should start picking up from 1 to 2 quarters from now.
Okay, so that's on the growth. Very quickly, just walk us through, by the time we get to this middle of next year, average, what will the margin profile look like? Are you expecting, because of this adoption of Gen AI, are you expecting 100 basis points overall dip in margins, 50 basis? If you're not expecting, then tell us. And just a quick last point on the use of that cash that you said. I mean, great cash war chest, but that's also been one of the biggest criticisms of Indian IT, that maybe they're just not aggressive enough, not looking at quicker reinvention through inorganic growth.
No, yeah, I think there is a clear dichotomy, probably I would say, between the large caps and the mid-tier companies around acquisitions. And I would say probably the global IT companies, particularly Accenture, they have been far more acquisitive, and particularly when a new technology cycle is getting initiated. So probably I think Indian IT companies will have to learn from how the global players have operated across cycles in order to reinvent themselves much faster than those global guys. And in terms of acquisition, it may not be a large scale-based acquisition, but more of capability-led, where they're either entering into new set of capabilities or into new set of clients or new set of geographies. So I agree. I think some part of that cash need to be invested on the M&A side. And I think as far as the aggression is concerned, we have seen some initial signs from TCS planning to invest probably $5 to $7 billion over the next 5-7 years to build data centers. Now, obviously, they are being aggressive, but probably market is not appreciating that fact, maybe because it will have some impact on their free cash flows and ROIC. But yeah, I think they need to be more acquisitive on the M&A side. And I guess to your another question, on the revenue per employee metric, that definitely will be the key thing to watch out for. Can you just, remind me your first question?
Margin, just in terms of margins over the next 4 quarters, should we expect them to go down, stay where they are? What should we expect?
So yeah, on the margin side, we expect them to be very stable, will not have a material impact given the fact that in terms of investment, they largely need to invest on employee reskilling. So there might be some impact on utilization from that in that regard, but no major capex is required. And on the margin side, I believe rupee depreciation will continue to remain a tailwind the way it has been over the last several years. And revenue per employee and pricing, those are the 2 key metrics to watch out for. If they are able to take that up, that will more than offset the investments required to reinvent themselves in the Gen AI world.
Yeah. Sumit, more questions, but out of time. Have a good conference, and thanks very much for joining us here on CNBC TV18. So that is Sumit with CLSA. From the sidelines of the conference, a view as far as IT services in India goes. Well, Inox Wind has reported a good set of earnings. Net profit is up about 42%. We have Devansh Jain, Executive Director of Inox GFL Group, now joining us. Just a couple of points I want to highlight before we get into the conversation. So, execution and margins in H2 versus what they've guided. I think that will be something we'd like to understand from Devansh. Demerger and listing of subsidiaries, substations, asset business. And of course, the sharp growth in Inox Green's portfolio is something we'll highlight as well. Devansh, once again, welcome to the program. Are you sticking, first up, Devansh, are you sticking with your guidance of 1,200 megawatts and margin guidance of 18 to 19% for the year? Q2 margins are 20% plus. So will you raise your margin guidance?
Hi, good morning, Prashant and Nigel. Yes, I think we're very happy with the numbers which have just come out this quarter. Of course, H2 is much larger for us. But yes, we are sticking to and maintaining our execution guidance at this point in time. We've just raised it in the last quarter. And I do recognize that our margins have been higher this quarter. And hopefully we should end at higher margins than what we've guided for in the full financial year. But at this point in time, we're sticking to our margin guidance. Naturally, H2 is going to be about 70% of the full year's business. So looking forward to Q3 and Q4.
So so it could be 20% plus, on margins and, revenue growth as well.
Well, as I said, we're looking forward to beating guidances which we've set out. We've already done that in Q1 and Q2, in spite of the fact that we've already raised guidances in the last quarter. But yes, hopefully we should outperform. What's
the order inflow outlook looking like in H2, Devansh? You said in your call that you might enter into long-term framework agreements ensuring large recurring annual orders.
Look, again, I would reiterate, I think our current order book is very, very strong at about 3.2 gigawatts, which gives us very, very clear, strong visibility for the next 18 to 24 months. Having said that, orders are the least of our worries. We've recently announced about 300 megawatts of orders. Lots of orders are in advanced stages of closure, which we will keep announcing as we move forward. But I think what we're looking to do now is strategically shift to framework agreements to secure multi-year orders. And I think that's something which we announced in this quarter, that we're looking at a couple of framework agreements, which should give us at least a gigawatt of recurring orders annually for every year for the next 3 to 5 years. So I think you should be hearing a lot more from us on that as we're moving forward. But I think it's looking very, very strong.
All right. Hi, Devansh. Good to see you. Give us an update on the demerger of the substation assets from Inox Green and its merger into the other subsidiary. I think that's Inox Renewable Solutions. Give us some timelines. And also basically, with regard to this demerger listing of IRSL, what's the benefit to Inox Wind? So an update on all of this.
So look, I think what we're doing is we're basically demerging the substation and the EPC arm of Inox Green Energy Services. And in the same scheme of things, consolidating it with the EPC arm of Inox Wind, which is under a company called RESCO, leading to automatic listing or what we call Inox Renewable Solutions, which will become the group's arm for all EPC works, for all our crane operations, for all our transformer manufacturing operations, and for the huge land bank and project site inventory, which is upwards of almost, say, 14 gigawatts of hybrid connectivity and sites which we control. The shareholder and creditor approvals are already in place for this. I don't think it should be too long. I think it should be the next few months. I'm not committing to timelines simply because NCLT is not in our control. We've done everything which we could as shareholders, management. As I mentioned, we've got all our approvals in place now. But I would expect in the next 4 to 5 months, we should see this business hopefully being demerged and listed as Inox Renewable Energy Solutions Limited. What that does is it creates a lot of value addition and is value accretive for both Inox Wind and Inox Green, simply from the perspective that Inox Green has a depreciation charge which moves out because we're removing this gross block. It also increases the ROC and ROE at Inox Green level. And at Inox Wind level, it leads to significant value unlocking and further shareholder value creation, because the intrinsic value of the entire land bank and EPC arm gets unlocked. As I mentioned, this also, Inox Renewable Solutions also controls the transformer manufacturing business as well as the crane ownership and operation business. So, all in all, a fairly interesting niche infrastructure engineering play, but very value accretive for both Inox Wind and Inox Green.
All right. Let's focus on Inox Green. Now, the portfolio is significant in the O&M segment because of the acquisitions that you're doing. And you have stated that Inox Green will become the largest renewables O&M company in India, I think so. Give us an outlook. How does it reflect in terms of numbers, ballpark revenue, EBITDA, profitability?
Look, so I think given our organic growth as well as some of the strategic investments we've made, through which we control, approximately 6.5 gigawatts of wind operations, our total O&M powered Inox Green currently is about 12.5 gigawatts. A lot of this, I would assume all of it, the entire 12.5, would be reflected in our financials in FY27. I think I can't commit to exact timelines, whether it's 3, 4, 5 months. But as I mentioned, over FY27, all of these investments should reflect in actual numbers. As I mentioned to you, we already control these companies. It's more a matter of time when they get reflected in exact financials. But certainly in FY27, you should see a multiplication, manifold increase in our profitability as the true reflection and full numbers of these 12.5 gigawatts start getting reflected. In terms of actual top line, I think 12.5 gigawatts should lead to approximately about 1,250 crores of top line. And at about 50% margins, that should, you can do the math, that should be at about 50% EBITDA margins. Having said that, I think we've also publicly stated that we're on track to become India's largest renewable O&M company, simply from the perspective that if you look at what our group IPP is doing, Inox Clean, as well as the solar manufacturing arm is doing, we expect to add, on average, between Inox Wind, Inox Solar, and Inox Clean, at least 5 gigawatts of capacity at Inox Green level every year. And this is besides the fact that we're still looking at multiple inorganic additions. So, I think next couple of months, we are well on track to become India's largest renewable O&M services company. But more importantly, at the scale of 12.5 gigawatts, we've created a very, very strong annuity business with very, very long-term contracts, which are married to us for life. And it just makes Inox Wind that much stronger, because now we have a very large annuity revenue pool, besides the fact that the wind turbine manufacturing business, in any case, is a fairly high EBITDA margin business for us.
Very, very aggressive targets, very focused. Devansh, pleasure speaking with you. Thank you very much for joining us. Had more questions, but out of time since we are still, earnings season has ended, but earnings, we're addressing a lot of earnings, so that's going to be the focus as we go forward, at least over the next 1 or 2 days as well. Thanks very much once again, Devansh. So a lot of guidance, especially on wind and, of course, green as well. Well, time for a quick commercial break here. On the other side, Manisha will be focusing on what's happening in commodities, what's top of mind. Stay tuned. Coming up.
Welcome back. Let's talk commodities. Manisha is here with all the headlines. Manisha, so what's hot this Monday?
Not really hot, but we're looking at silver right now. That is because after October, November seems to be ending on a negative note again. We've seen all-time highs in silver for the month of October, but it hasn't been able to sustain there. So $54.50 an ounce is an all-time high. But since then, we've seen prices continue to decline, 2.5% of a decline on a month-on-month basis. And since the month of October, we've seen 54.5. Silver actually has seen a range of anywhere between 48 on the lower side to 54 on the higher side. Having said that, silver clearly has been an outperformer when you look at various other commodities where energy is in the negative, base metals just about 20 to 30% higher, but silver is giving you 76% of returns in this year till time. If you look at the chart on how we have been in this year for silver, we started the year with 29.5. It was by the month of June, mid-year, that we had already crossed nearly $8 to $9 in cents of silver. And then 40 was as easy, and we saw $45 an ounce for the month of September. And since then, it has been nearly $10 of a gain in the next 2 months, where we saw 54.5 at an all-time highs, and 50.5 is where silver is trading at this point in time. So very, very strong gains, as you can see. The whole year, every month almost gave you strong returns when it comes to silver there. Well, we have seen tightness in sense of supplies. This is a fifth straight year of deficit, with the markets believing that until 2027, it could continue to be a deficit of a market. Apart from that, there also has been very strong investment demand that we saw in silver this year. Remember, this year started with the saying that silver will outperform, and that perhaps is the way to be. And then the way silver kept rising, you saw HNIs, physical buying, ETF buying, all of that continuing quite strong. And then the industrial demand has been on the positive side as well. So whether it's from green energy, solar, electricals, electricity, all of that demand also came in very, very strong there. When you look at the forecast going forward for 2026, the expectation is that silver perhaps could consolidate to perhaps continue to make higher highs. So the most bearish of numbers really seem to be coming in from Macquarie at $34 an ounce. That perhaps might go change going forward, because we're trading almost $15 higher from those kind of levels. World Bank believes that 41 of an average is what you could be looking at in the next year. And then it is between 43 to 45 from Citi, HSBC and Deutsche Bank as well. But then there are bulls into the market as well. ING believes that 50 of an average is what you could see in the next year. And then you have 56 coming in from Wisdom Tree. Most bullish, clearly, are Bank of America and Goldman Sachs, anticipating newer all-time highs and $15 higher from where we're trading right now. So while we're trading at $50 an ounce, 65 of an expectation is what is coming in from both of these banks for 2026.
Okay, all right, Manisha, thanks very much for that. So that's commodities in focus there. Time for a quick break. On the other side, our special Market Master segment, Lata in conversation with Timothy Moore of Goldman Sachs on why Goldman has turned overweight in India after a full 1 year. Coming up.
Hello and welcome to a special Market Masters edition that coincides with the end of the second quarter earnings season. The question we're asking our guests is whether the results season shows a clear recovery in Indian earnings and hence will the foreign investors return? Our guest today is Timothy Moe, co-head of Asia Macro Research and Chief Asia Pacific Equity Strategist at Goldman Sachs. We have invited him because Goldman Sachs has just turned overweight on India from their underweight position almost 13 months ago, since October 2024. Timothy, thank you very much for coming into our studio. That's
thank you
making
very
it
much.
all the better. Okay, well, straight away, why have you turned overweight on India?
Really, Lata, the reasons are that the causal factors for engendering our downgrade 13 months ago, as you mentioned, have dissipated and look as though they're turning aside. So to be specific, we downgraded for two main reasons. One, that a lot of India's good news got priced into the market valuation in September, October of last year, when the market was trading about 25 times forward earnings. So we've been very positive in India, as many people have been, but felt a lot of that was in the price. So that was number one. And number two, we had a developing conviction that there would be what we were terming a mid-cycle slowdown in the economy and in earnings. And as I'm sure you're aware, when you have a richly priced stock meeting a downgrade, you tend to get some hyperactive move to the downside. So we just felt, look, let's step back here and take our foot off the accelerator and take our view down. And we're fortunate that our timing was reasonably apt. And since then, India has underperformed by the most in a decade or two, particularly compared to China, which has come out of its doldrums and has had a very good year. So if you look at the scorecard for year-to-date market performance, China's up 35%, and India just recently was up only 2-3% in dollar terms. And that's MSCI India, but Nifty pretty much the same. So what we figured, to your question, is, well, number one, there's been some moderation in valuation. Not colossal, but the market was coming down to maybe 22 times. So it kind of grown into its valuation to some extent. Number two, quite clearly, the economy had slowed down, but was showing signs of stabilization. And in fact, even has printed above expectation numbers for second quarter of calendar year, first quarter fiscal year. And we've been toning up numbers overall. And then at the market level, there's clear signs that the persistent downgrade cycle for earnings has really stabilized. If you look, for example, at a measure of breadth, number of analysts downgrading versus upgrading, and this is your zero line, we got to really, really deep. Almost everybody was downgrading. Now it's basically flat, and even there's a touch of upgrades. And if you look at the most recent quarter, which you mentioned, the expectation coming into that was about 9% year-on-year growth for the full market. It's actually going to come out more like 14, about 5 percentage points above. So there are signs at the earnings level that things are coming into play. So you put all that together, and we just feel that the risk reward for India is now turning more favorable, especially because foreign investors have sold, since they started selling last year, about $30 billion US in this downgrade, this down selling time, which is the second largest in absolute terms and relative to market cap on record. And even year to date, there's about 16 billion in net selling, which has gone on. And so if you've got lighter foreign positioning, you've got an economy which is stabilized, looks like it's picking up a little bit. Earnings, we think, will grow on a compound basis, maybe 13-14% next couple of years. Market valuation is still rich, but acceptable. We did a bunch of work on that. We just feel risk reward looks better for India. So we figured it's time to pull the trigger.
Very good. That suits us. But do you, which sectors are you impressed with? Are you impressed mostly with consumption? Because that's where the government has given everything it can, rate cuts, tax cuts.
Indeed, Lata. So we very much like the mass consumption theme. So I'll answer your question this way. There are a number of themes that we particularly like, which, as I said, to start with your question, would be mass consumption, because obviously the underlying dynamics, demographics, large population, per capita incomes are rising, people's consumption habits change. This is your classic sort of developing market or developing economy story, and we think that India has much to play for in that regard. Additionally, we like the theme of self-sufficiency, and this plays into defense, into energy sufficiency, and so forth. So there's a lot of aspects there our analysts just did a very large report, 140-page report on initiating on the Indian defense sector. And defense is a theme which we've liked regionally and globally, and I think for many reasons, which I'm sure we'd all agree with.
Yes.
In a fractious geopolitical environment, which we find ourselves in today, the theme of defense is one that's played very, very well. And we think India has some catch-up to go in that. And so we're quite excited about that theme, along with the theme of energy sufficiency. We also like the theme of the new economy. This is leaning into the digital economy and more delivery.
E-commerce.
Correct. Yeah, e-commerce, fast delivery, all that sort of stuff, where you see a transition from your analog to digital economy. It's not a theme unique to India, but there's a lot to play for in that regard. And then just simply the theme of high growth, where we find there are many companies that are offering good growth opportunities, particularly in the smaller mid-cap space, where you've got early emerging companies that tend to do better. So we like those four themes. And then from a sector perspective, that will be manifested in a number of the consumer areas in terms of durables. Some of the financials, the banks have particularly come out of a period of credit constraint. And so we actually initiated an investment view of longing financials versus Nifty. We thought that was an interesting catch-up performance trade for the banks. And then some select higher growth areas as well. So that's sort of our view within the market.
Okay. Just zooming out, what would be your pecking order, since you specialize in all of Asia? What's the pecking order in terms of countries in Asia?
Well, it's a great question. And frankly, we're a bit spoiled for choice here.
Good.
Because we like a lot. And I think the trouble we're having in terms of finding things that we don't like as much is, I think, an indication that the broader appeal and potential for Asian equities actually still looks pretty good, even after a very strong year. MSCI Asia Pacific ex-Japan Index is up 25% this year, and 40% off the lows in early April. And so we think that can continue into next year for reasons we can explore a little bit later. And as I said, we're somewhat spoiled for choice. So to be more specific, we've had a very, very positive view in Korea, which is the superstar this year.
Because of the AIs.
Yeah, stratospheric performance. It was up actually up 90% nearly in dollar terms. And it's had a bit of a correction, but still up roughly 80. And one might think, well, after that, it's probably going to cool off. But even with that significant performance, Korea is still trading at 11 to 12 times earnings. And a good part of that is that, number one, the earnings delivery has been very, very strong because of the AI theme and so forth. But also, we're having a re-rating structurally of Korea because of better corporate governance, which I can get into further if you wish. But the point is that this rally in Korea started literally from 8 times earnings. So even if you're up a lot, you've only reflated to 11, 12 times earnings, which means there could still be plenty more to go for. So we like Korea. We like China. We just put out a view that over the next 2 years, we think China can go up 30% in price terms, maybe another 5% in dividend yield. And again, we think there's some structural reasons there. Taiwan, which are market weight on, but also looks good because you've got a very strong AI component there and some broader tech elements. So North Asia, we think, still looks good, including Japan, by the way.
Okay.
But then India, we like also. Maybe it's a bit early, and maybe it's going to take a little bit of time to catch up, but we like India as well. So those would be our top picks. To balance that out, in an Asia perspective, we're underweight Australia because it's richly valued and doesn't have as much growth. Not that we're necessarily outright bearish, but think it still will perform less well than the others. And then trying to be underweight as much of ASEAN as we can. These are the smaller markets, Indonesia, Malaysia, Thailand, Philippines, and so on, because they just don't have as much of that tech-focused driver.
Yeah. Clearly a developed country choice more. But, the start of this year, not start, maybe after the Liberation Day, after February 1, announcements from Trump, economists actually turned very negative on global growth because of uncertainty. You won't know where to invest in which product because you don't know when you will be hit by how much tariffs. That was the narrative we got. But in your report, you'll have upgraded growth forecasts for practically every region, for the world, for the US, for parts of Euro area, and of course for Asia, in a big way, even for India.
Yeah.
Why did it change?
So great question. So first of all, we and many other economists are upgrading our forecasts on a fairly dynamic basis, given the information which comes in. And so the point of reference that you took just after Liberation Day was the nadir, the worst part of the forecast, because at that point we were looking at very, very elevated tariffs. And of course, there was this sort of tit-for-tat escalation between the U.S. and China, where you had such colossally high tariffs that it basically was equivalent to an embargo in trade. And of course, that would have been very, very damaging for both economies. So we marked down our growth views dynamically quite aggressively. And just to give one or two numbers, we started this year, taking China as an example, with about a 4.8% GDP growth forecast for the full year. And that got marked down to about 4.1 in early April. But then, of course, as some of that tariff increase was walked back, and in China's particular case, we saw exports doing much better than we had thought, and I think consensus, we progressively marked up our numbers, so much so that today we're actually standing at 5% GDP growth for this year, and we just did the biggest upgrade to our China forecast in probably a decade, adding 50 basis points and 70 basis points to our 2026 and 2027 numbers. Now, because of this leaning into high-tech manufacturing and China's export competitiveness, and also the leverage they've got through rare earths. So the point of all this is that we've seen kind of a walking back of some of the worst fears, number one. Number two, to your question, that sort of reduces at least some of the uncertainty and makes it a little bit better environment for investment. Number three, a lot of that investment has come in, particularly in the U.S., in the hyperscalers and AI, which is really separate from the whole tariff area of concern. And then number four, just if you look at the data which has come out, just empirically, the world seems so far to be doing better than one would have thought given the higher tariff levels. So people are just learning to live with it to a better degree. So all of that contributes to that increase in the growth forecast.
What do you think will be the catalyst that other foreign funds will wake up to the change in sentiment over India? Do you think this catalyst could be only the trade deal? Unless that happens, people are not going to come in?
So I think it's a few things like that. So if there is an announcement between the U.S. and India, as seems to be rumored, of course the market would look at that as a good thing, because if this extra, for example, 25% tariff surplus is eradicated, and maybe there's even agreement to go to something along the lines of what both Korea and Japan have arranged bilaterally with the United States, which is about a 15% base case, with maybe, in each case, Korea or Japan buying more from the U.S. and then also investing more in the U.S. If there's some sort of agreement along those lines with that sort of flavor, I'm sure the market would take that well. Now, I don't think that the full 25% additional tariff surplus has been fully priced in, because most investors thought, well, it's probably not going to last for a long time. But the market has certainly expressed and priced some sort of concern over that. So if you know for sure that's not going to be there, that's going to be a positive. So I think that in terms of near-term catalysts, that's one which we can look to. But the other ones, I think, from an India-specific perspective, really would be delivery of growth. Because I think the broader picture for India is that valuations are full. I mean, 22 times earnings, hard to argue things are on sale. We did a big piece which looks at valuations from a variety of different perspectives. And the punchline is that we think that these valuations are defensible, but we're not calling for an increase here. We think there may be even a little bit modest decrease, but roughly speaking, we could hold on to the current level. Ergo, in order to really power India and to rekindle foreign investor interest, India earnings have to come through. So I think it's really earnings delivery as we go through time will be the catalyst to get interest coming back.
A final question, and this is a macro market conflict I have in my head. India's macros have improved. We were a country up until 2013 with a 6% inflation on average. And because we adopted inflation targeting and went after it, now we have constrained our fiscal deficit, and inflation is averaging about 4%. That is reflecting in lower nominal GDP and probably impacting earnings. But that's a good reason why earnings and nominal GDP are lower, because we controlled inflation. Don't you get brownie points for that? Or do investors like you only look at the earnings number?
No, it's a great question. I concur with you. I think that if you have an environment where you have better real growth or very good and solid real growth and inflation under control, that is a much healthier environment. And I think full credit to India for the fiscal consolidation which has taken place, but it's been done in a gradual manner, so you kind of thread the needle between wanting to be more prudent fiscally without doing so much that you then hurt growth and have a negative spillover effect. So I think that the policymakers have done a very commendable job in that regard. I think that the silver lining, as you said, in that slight cloud of lower nominal GDP is that a lower inflation environment certainly allows the RBI to be more accommodative. And I think it also may calm fears about currency weakness. So if you get a more stable rupee and lower interest rates, well, lower interest rates are obviously good for markets through valuation. So I think that, there's that positive pass-through effect from lower rates, which may mitigate the lower.
No, you're right that, the inflation differential narrowing so much between India and the US is not reflecting in the currency just yet.
Correct.
But do you think the rupee's worst is over?
So our overall view, as I mentioned earlier, is that the U.S. dollar should weaken on a structural basis. India's had some challenges this year, and the rupee's been on the weaker side, along with the Indonesian rupiah. But we think here it's sort of probably roughly range traded stable. Okay. So we don't think it appreciates as much as some other currencies, for example, the Korean won, which I think is very undervalued here. It should rise, and the Taiwan dollar as well. But we think it can sort of hold its own. So I think from a U.S. dollar investor perspective, you're probably okay in U.S. dollar, keeping score in U.S. dollars. And then the real heavy lifting will have to be done by earnings delivery and growth.
Okay, thank you very much, for all the positive things that you've said. Thank you for coming into our studio. And we do hope the other foreign funds and investors follow your excellent example.
Yeah, we're hoping so too.
Yes, of changing your stance. Well, that's it on this edition of Market Masters. Thanks so much for watching. After break, time for Chartbusters.